Welcome to another deep dive. Okay, let's unpack this. Today we're zeroing in on a company that's, well, absolutely foundational to the vast, intricate network of North American industry. Yet, you might not often hear its name in the headlines. MSC Industrial Direct Co. Inc., ticker symbol MSM on the NYSE. Now, you might be asking yourself, what exactly is an industrial distributor? Maybe, why should I or a curious listener care about a company that, you know, primarily sells cutting tools and safety supplies? Well, here's the crucial point. They are the quiet, indispensable engines, really. They're the ones ensuring thousands of factories keep operating, the gears keep turning, and our economy hums along efficiently. Our mission for this deep dive is really to move far beyond the surface-level stuff. We're going to truly understand the nuts and bolts of a company like MSC Industrial Direct, especially as it navigates both these powerful, overarching market forces and, frankly, some very visible internal challenges. This isn't merely about business metrics. It's about appreciating the complex, often unseen network that underpins our modern industrial world. You'll find it quite compelling, I think, as we peel back these layers.
Indeed. And the core tension for anyone looking at MSC Industrial Direct, particularly, as an investor, it stems from this fascinating duality. It really does. On one side, you've got its firmly established critical position within a massive, albeit fragmented market, a really big market. On the other, it faces significant headwinds. And these challenges are, importantly, both external, like a pronounced cyclical downturn in its core manufacturing end markets, and internal. Critically, the company has experienced what it actually calls self-inflicted operational stumbles. That was their phrase, particularly in executing its strategic digital transformation. The recent financial performance, marked by declining revenues and compressed operating margins, it vividly illustrates the impact of these combined pressures. It's quite stark. So our deep dive today aims to tackle a few central questions for you. Firstly, can MSC's management effectively correct its recent execution failures? Can they successfully replatform their e-commerce business to regain momentum with that crucial core customer base? That's no small feat, obviously. Secondly, does the company's current valuation adequately account for the significant cyclical risks inherent in its business model and the heightened execution risk demonstrated over the past year? And conversely, the potential for a substantial operational recovery if its strategic initiatives actually succeed. Our purpose here is to arm you with the essential data and the necessary context to evaluate these pivotal questions, delivering those precise nuggets of knowledge that truly complete your understanding of MSM.
Those precise nuggets are exactly what we aim for. So let's begin by uncovering MSC's fundamental identity. What exactly is MSC Industrial Direct? At its core, MSC functions as a leading North American distributor of metalworking and maintenance, repair, and operations, usually called MRO products. Think of them as a vital intermediary in the industrial supply chain. They bridge the gap, you see, connecting thousands of product suppliers with a broad, diverse base of industrial end users. Their role, however, it extends far beyond simply fulfilling orders. Their true value proposition is intricately woven around helping customers significantly reduce their total cost of ownership for these MRO and metalworking supplies. That's the key phrase. So how do they achieve this? Well, they actively enable supplier consolidation, meaning a single factory, instead of managing relationships with dozens of different vendors, can streamline its purchasing through MSC, much simpler. They offer sophisticated inventory management solutions, provide crucial technical expertise which is vital for selecting and using complex tools, and ensure timely, reliable product delivery. By meticulously streamlining the procurement process, MSC helps its customers cut down on administrative burdens, lower inventory carrying costs, which, in industrial operations, can be really substantial, and ultimately enhance their operational efficiency. All of this is strategically designed to, quote, drive greater productivity, profitability, and growth for their clients. So for you, our listener, envision them not just as a supplier or a store, but as a strategic partner. An efficiency architect, almost, for industrial businesses, working tirelessly behind the scenes to keep things moving.
Right. And delving into their offering, MSC's product portfolio is, well, it's impressively extensive and diverse. We're talking approximately 2.4 million active stock keeping units, or SKUs. Those are the unique identifiers for each distinct product they sell. It just shows the immense depth of their catalog. This vast catalog is largely segmented into two primary categories: metalworking and MRO. Metalworking, notably, represents MSC's historical area of strength. It really serves as a key differentiator for them. This segment includes a comprehensive range of cutting tools, specialized tooling components, abrasives, machinery accessories, all that stuff directly used in critical manufacturing processes.
Okay, so that's their traditional sweet spot.
Exactly. Now, why is this distinction so significant? Well, the highly technical nature of these metalworking products, it necessitates a very specialized sales force, people with deep application knowledge. This technical expertise forms a durable competitive moat, you could say.
Hmm.
It effectively shields MSC from more generalist MRO distributors who simply can't replicate that specialized insight.
Makes sense.
However, and this is the crucial however, this very specialization also creates a profound cyclical vulnerability. It disproportionately concentrates the company's exposure to the most cyclical segments of the industrial economy. We've heard it on recent earnings calls. They've explicitly attributed MSC's weak performance to a deteriorating environment in metalworking and heavy manufacturing end markets. And this isn't just talk. It's been powerfully corroborated by data from the Metalworking Business Index, the MBI. That index specifically tracks activity in the metalworking industry, and it indicated contraction for an alarming 19 consecutive months as of late 2024. 19 months.
Wow, that's a long downturn.
It really is.
Yeah.
Now, shifting to the other side of their portfolio, the MRO category. This includes a broader array of products essential for the day-to-day running of an industrial facility. Think fasteners, safety equipment, janitorial supplies, plumbing components, electrical parts, material handling equipment. The list goes on. So to put this into a broader context for you, this strong linkage to metalworking means MSC's financial results are inherently more sensitive to the broader manufacturing cycle than, say, broadly diversified peers might be. An investment in MSC, therefore, becomes a kind of leveraged play on a potential recovery in U.S. durable goods manufacturing and machining.
A leveraged play. I like that framing. It really is a double-edged sword then, isn't it?
Yeah.
That deep specialized expertise comes bundled with deep cyclical exposure.
Precisely.
And that depth of expertise is likely why MSC's business model goes beyond just, simple product transactions. While the revenue primarily comes from product sales, a pivotal aspect of MSC's strategy is to enhance these sales with a pretty sophisticated suite of value-added services. These aren't just add-ons. They are meticulously designed to integrate MSC more deeply into its customers' operational workflows, to really elevate their role from just a transactional spot-buy supplier to an indispensable mission-critical partner. That's their goal. Let's maybe delve into some of these key services. First, they provide comprehensive inventory management solutions. This includes things like vendor-managed inventory or VMI programs. That's where MSC actually takes responsibility for monitoring and restocking items right at the customer site.
Saves the customer a lot of hassle.
Exactly. They also deploy industrial vending machines, strategically placed within customer facilities. These allow workers immediate, 24/7 access to tools and supplies right where they need them. For larger operations, they even offer in-plant solutions, where MSC associates directly manage a customer's entire tool crib or storeroom.
Right, and these services don't just boost customer efficiency. Crucially, they cultivate really high switching costs.
Good point.
Yeah, once MSC is deeply embedded in a company's day-to-day operations like that, the effort and disruption needed to switch providers becomes a significant barrier. It really locks them in.
Got it. So beyond inventory, MSC offers vital technical support too, right?
Yes, they employ a dedicated team of metalworking specialists. These folks provide on-site technical assistance and application expertise. They help customers optimize their manufacturing processes, maybe suggest better tools or techniques, and even quantify measurable cost savings, showing that tangible value.
And they also do consulting.
Sort of, yeah. Supply chain consulting. By leveraging their vast transactional data and systems, MSC provides customers with actionable insights aimed at reducing costs throughout their supply chains and operations.
So these services, they're not just a nice to have for the customer, they're a strategic imperative for MSC. It's how they build loyalty and defend margins in this really competitive market.
Absolutely. And considering the wider implications, MSC serves a remarkably diverse customer base. We're talking the United States, Canada, Mexico, the UK. The spectrum ranges from, small, agile, independent machine shops all the way up to Fortune 100 manufacturing behemoths and even critical government agencies like the Department of Defense.
Quite a range.
It is. Yet, despite this seeming diversification, MSC's core customer base, as they define it, maintains a significant concentration in manufacturing. particularly in sectors that are acutely sensitive to economic cycles. Management has been quite explicit about this, identifying end market weakness in areas like automotive, heavy trucks, primary metals, fabricated metals, machinery, and equipment, listing those as primary drivers of their recent underperformance.
So the pain points are pretty specific.
Very specific. And the essential takeaway here for you, the listener, is that this heavy exposure to durable goods manufacturing fundamentally underscores the company's inherent vulnerability to macroeconomic downturns. Any downturn that impacts industrial capital spending and production volumes hits them hard. Grasping the nature of their customer base is really key to understanding the inherent volatility in their business model. MSC's fortunes are quite literally intrinsically tied to the very pulse of the industrial economy.
Okay, so we've established what MSC does, who it serves. Now let's widen our lens a bit to the competitive landscape they operate in. It's pretty noteworthy that the North American industrial and MRO distribution market is characterized by its, well, immense scale, just huge. MSC itself estimates its total addressable market, the TAM, the maximum revenue opportunity available to them, to be approximately $215 billion in annual sales.
Billion with a B, that's an enormous pie.
Right, an enormous financial pie. However, despite this colossal size, the market structure is highly competitive and incredibly fragmented. Get this, the top 50 largest distributors combined account for only about 1/3 of that total market.
Only a third. Wow.
Yeah, leaving a vast majority served by literally thousands of smaller, regional, and highly specialized distributors. Now, this fragmentation presents both a compelling opportunity and, of course, a significant challenge for a company like MSC. It offers a long-term pathway for consolidation, for market share capture by larger, well-capitalized players. Yet it simultaneously fosters a hyper-competitive environment, especially for those less technical MRO products and the transactional spot buys. This leads to persistent, often intense pricing pressure. It sounds like a relentless contest for every dollar.
Precisely. And a particularly compelling aspect of this market is how MSC has to navigate both these powerful cyclical forces and the enduring secular trends. The most significant short to medium-term driver for this industry is, without question, the overall health of the industrial economy. You really can't overstate that. Key indicators like the Industrial Production, or IP Index, which measures output across manufacturing, mining, utilities, and the ISM Manufacturing, PMI, gauging manufacturing health through purchasing manager surveys. These are closely watched barometers of customer demand.
Right, those are the big ones.
Yeah. During economic expansions, you see rising factory utilization, increased capital investment that naturally leads to higher consumption of MRO products. Pretty straightforward. Conversely, during contractions, customers defer maintenance, they reduce production, and demand for these essential supplies inevitably contracts. But here's where the dapper long-term trends emerge. Several secular forces are fundamentally reshaping the industry, and they offer both considerable challenges and unique opportunities. Think about Industry 4.0, the rise of advanced manufacturing, integrating technologies like IoT sensors, predictive maintenance. This is creating demand for far more sophisticated MRO solutions, data-driven inventory management.
So it's getting more complex.
Definitely. Then there's the ongoing trend of supplier consolidation. Industrial customers increasingly want to streamline their purchasing by reducing their supplier base. This dynamic explicitly favors large broadline distributors like MSC over smaller competitors. And of course, the powerful shift from traditional purchasing methods, phone calls, paper catalogs to e-commerce, that's another major force compelling distributors to invest heavily in robust digital capabilities. The intricate interplay of these forces means distributors like MSC must be exceptionally agile. They have to constantly adapt to both the unpredictable economic swings and the relentless march of technological advancement.
Agile is certainly the operative word there. So given that hyper-competitive, fragmented market, how does a company like MSC build and maintain what we call a moat, that durable competitive advantage that protects its business? Despite the market's fragmentation, the industrial distribution industry actually presents significant barriers to entry for new players trying to compete at scale. These barriers form the very bedrock of the competitive advantages for established companies like MSC. Let's maybe dissect these key barriers. First, scale and logistics are just paramount. A sophisticated, highly efficient supply chain is non-negotiable. It demands massive investment. You need an expansive network of distribution centers, that extensive inventory. Remember, MSC's 2.4 million SKUs in cutting-edge logistics technology to deliver the rapid, reliable service, often next day, that customers absolutely expect.
Table stakes, really, at that level.
Pretty much. Second, there's product breadth and supplier relationships. Building a portfolio of over 2 million SKUs requires establishing and meticulously maintaining relationships with thousands of suppliers. That process takes decades to develop, and it yields substantial scale-based purchasing advantages. It's not something a startup can just replicate quickly.
No way. Those relationships are deep.
And finally, technical expertise and customer integration. For those high-value customers, the relationship transcends simple transactions. It's more than just price. The deep technical expertise of a specialized sales force, combined with the profound integration of inventory management solutions like those in-plant vending machines we talked about, creates incredibly high switching costs. It forms a truly durable competitive advantage that can't be easily matched by a generalist or a purely price-focused competitor. So what does this all signify for MSC's strategy? Well, it explains precisely why their strategic pivot from being just a spot-buy supplier to aiming to be an indispensable mission-critical partner is so vital. It's the mechanism through which they build that enduring customer loyalty and robustly defend their margins against the intense price competition inherent in this industry. Makes a lot of sense when you lay it out like that.
It does. And that concept of a competitive moat naturally leads us to evaluate MSC's standing within its competitive arena because it faces some truly formidable opponents. MSC Industrial Direct, with its trailing 12-month revenue around $3.74 billion, is undoubtedly a substantial player. Let's be clear on that. However, it operates in the distinct shadow of two significantly larger public competitors. There's W.W. Grainger, ticker GWW, which reported a staggering $17.2 billion in revenue for 2024.
17 billion, that's huge.
Massive. And Fastenal, ticker FASTE, with TTM revenue of $7.55 billion. So more than double MSC size. A more direct peer, maybe in terms of scale and market focus, is Applied Industrial Technologies, AIT, which posted fiscal 2024 sales of about $4.5 billion. Still larger, but closer. This competitive landscape clearly positions MSC in a challenging space. They need to vigorously defend their specialized niche against smaller, regional players, while simultaneously contending for large national accounts against rivals who have far greater scale, deeper resources, and in some cases, more advanced service models.
Right, MSC finds itself in this really challenging position, kind of caught between these industry giants. And each of these major competitors uses a distinct strategic approach, which in turn creates unique competitive pressures for MSC. Let's start with W.W. Grainger. GWW Grainger executes this formidable dual-segment strategy. It's pretty clever. Their high-touch solutions segment provides a value-added service model quite similar to MSC's, targeting those large, complex customers. But here's the strategic double punch. Simultaneously, their endless assortment segment, primarily operating through Zoro.com, aggressively targets the transactional market. They boast a colossal product offering of over 14 million items, running on a pure-play e-commerce model.
14 million SKUs, that's incredible breadth. Exactly. Grainger's sheer scale and its highly developed digital infrastructure represent a direct and significant threat to MSC's own e-commerce ambitions and their goals for growth in large accounts.
Yeah.
They're really pressing MSC from multiple angles. Then you have Fastenal, FAST. Their strategy is fundamentally centered on being physically close to our customers. That's their mantra. This is powerfully executed through their industry-leading on-site program, where they literally manage inventory directly within a customer's facility, like they have people on site.
Embedded.
Embedded, exactly. And through their vast network of industrial vending machines. While MSC also offers point-of-use solutions, Fastenal has undeniably established itself as the market leader in this highly integrated service model. This approach cultivates exceptionally high customer retention and forms a powerful competitive moat that's extremely difficult to penetrate.
Yeah, that on-site model is tough to compete with. Definitely. Finally, Applied Industrial Technologies, AIT. They represent a different kind of competitor. AIT is less of a direct broadline rival and more of a specialized technical distributor. Its primary focus lies in product categories like bearings, power transmission, fluid power, areas where it offers profound engineering expertise. So AIT primarily competes with MSC within these specific technical niches rather than across the entire MRO spectrum. So for MSC, this means they are strategically squeezed, aren't they? Contending with giants possessing superior digital platforms or unparalleled physical integration, while still needing to fend off thousands of smaller, more agile players. It's a crowded and intensely competitive arena.
It really is. And given this competitive context, digital capability has, quite frankly, emerged as a critical battleground. And unfortunately for MSC, a recent area of pronounced weakness. In 2024, the company's management publicly conceded they admitted that delays in our website improvements and other technology-related execution challenges were a primary cause of softness and lost momentum with its core customer base.
That's a big admission.
It's a very significant admission. It clearly indicates that MSC is currently lagging behind the digital sophistication of competitors like Grainger, which, has been making substantial investments in its e-commerce platforms for well over 2 decades now. They had a big head start.
Right.
Regarding its physical infrastructure, MSC's distribution network comprises several large customer fulfillment centers, or CFCs, those big warehouses optimized for rapid order processing and shipping, alongside a network of smaller branch offices. In a strategic move to enhance efficiency, especially amidst this challenging demand environment, the company recently decided to close its Columbus, Ohio CFC. This consolidation project is anticipated to yield annual savings of about $5 million to $7 million.
Okay, so trimming costs there.
Exactly. This action underscores a strategic focus on optimizing its existing network for profitability and efficiency rather than aggressive expansion. It reflects the pressures they are currently operating under.
Those are indeed crucial strategic adjustments, reflecting a tough environment. The numbers, though, often provide the clearest, most objective narrative. Let's examine that peer comparison matrix we have, using data from late 2024, early 2025, to get a quantitative snapshot of MSC's position relative to its main competitors. First, let's look at market capitalization. MSC stands at roughly $5.05 billion. Now, contrast that with Fastenal's staggering $56.21 billion and Grainger's $46.48 billion. Huge difference.
Orders of magnitude larger.
Right. Applied Industrial Technologies, AIT, at about $9.83 billion, is closer in scale, but still significantly larger than MSC. This starkly illustrates the profound difference in market scale. Next, trailing 12-month, or TTM, revenue. MSC reports approximately $3.74 billion. Fastenal, $7.55 billion. Grainger, $17.48 billion. And AIT, $4.56 billion. This just reinforces that substantial revenue gap. Now, when we turn to profitability, MSC's gross margin, TTM, is actually quite competitive at approximately 40.9%. Fastenal is somewhat higher at about 45.2%, Grainger is a bit lower at 39.3%, and AIT is lower at 30.3%. So on the gross margin front, MSC holds its own pretty well, doesn't it?
Yes, that's been a traditional strength. They manage their cost of goods sold effectively.
But this seems like the big but. The real story here isn't just that MSC faces operational challenges, but that its inability to translate those strong gross margins into comparable operating margins is a profound indicator of its current issues.
Right. Issues with strategy, the digital lag.
That's exactly right. The leverage or lack thereof really shows up there. Okay, so let's look at operating margin, PTM. MSC is at approximately 8.5%. Fastenal, significantly higher, around 21.0%. Grainger, 15.5%. AIT, 11.0%. So MSC lags significantly here. It signals clear and pressing operational pressures.
Very clear pressure on the bottom line operational efficiency.
Now, valuation multiples. Let's look at the price to earnings, or PE ratio, TTM. MSC is around 25.6x. This means investors are currently paying $25.60 for every dollar of the company's past year's earnings. Fastenal is much higher at approximately 47.1x. Grainger is around 25.9, and AIT at 25.5x. So MSC is valued similarly to Grainger and AIT, but at a substantial discount to Fastenal.
The market clearly sees Fastenal differently. More consistent, higher growth, maybe?
Seems like it. Now, the enterprise value to EBITDA, TTM, or EBITDA, that's a measure of a company's total value relative to its earnings before interest, taxes, depreciation, and amortization, tells a similar story. MSC is at approximately 13.5x, Fastenal way up at 33.1x, Grainger at 16.1x, and AIT around 18.1x. Again, MSC trades at a discount to most of its peers here. But finally, dividend yield. MSC stands out with a yield of approximately 3.74%. Compare that to Fastenal at 1.8%, Grainger at 1.0%, and AIT at 0.69%. So the dividend is attractive.
It is, and that's clearly part of their value proposition to shareholders.
So the critical insight from this comparison, I think, is that MSC demonstrates competitive gross margins, but this strong foundation is kind of undermined by its operational challenges. These challenges are clearly reflected in its significantly lower operating margins and, consequently, its lower valuation multiples compared to its larger, more efficient peers, especially Fastenal. These numbers don't just tell a story, they highlight a strategic imperative for MSC.
Absolutely. And that narrative of operational pressure is vividly reflected when you look at the company's historical financial performance. A review of MSC's past revenue trends distinctly illustrates a business that is, well, highly correlated with the broader cycles of the industrial economy, no surprise there. Following a period of pretty robust growth after the initial COVID-19 downturn, the company's top line has recently started to contract. For its fiscal year ended August 31st, 2024, MSC reported net sales of $3.82 billion. That was a 4.7% decrease from the $4.01 billion they recorded in fiscal 2023. And this decline has unfortunately persisted into fiscal 2025. Their trailing 12-month revenue as of the third quarter, which ended May 31st, 2025, fell further to $3.74 billion.
So the trend is still downwards recently.
It is, and this trend directly mirrors that persistent slowdown in U.S. manufacturing activity that began back in 2023 and continued throughout 2024. For you, our listener, this powerfully demonstrates how those external macroeconomic forces directly and significantly impact the company's top-line performance. It makes it, as we've noted, that leveraged play on the industrial cycle. When the industrial economy catches a cold, MSC feels it immediately and acutely.
And it's not solely the top line feeling the pinch, is it? Profitability has also faced considerable pressure. MSC seems to be experiencing a double impact, stemming from that combination of negative operating leverage from falling sales, broader cost inflation, and the internal execution issues we've highlighted.
A perfect storm, almost.
Yeah. Historically, MSC's gross margins have been a consistent strength, typically hovering in the low 40% range. For fiscal 2024, they reported a gross margin of 41.2%. Pretty good. However, management specifically noted an unexpected dip during the third quarter of that year, and they attributed it to unforeseen complexities in their web pricing realignment initiative. That digital stumble again. While they said countermeasures were swiftly implemented, the gross margin in the third quarter of fiscal 2025 stood at approximately 41.0%. So it indicates that while the sharp decline might have been stopped, a substantial recovery hasn't really materialized yet.
Yeah, stabilization, not recovery, it seems.
Right. And the impact of this sales decline is most pronounced in the company's operating margin, which has compressed significantly. The adjusted operating margin actually fell by 190 basis points year over year in fiscal 2024, settling at 10.7%. This compression has unfortunately continued into fiscal 2025, with the adjusted operating margin for the third quarter coming in at just 9.0%. It's a noticeable decline from the prior year period. Why is this so impactful? Well, it vividly demonstrates that high degree of operating leverage inherent in the business model. This means that a decline in sales, especially when coupled with ongoing strategic investments in areas like technology, leads to a disproportionately larger decline in profitability. It's like trying to slow down a big ship, right? When the revenue engine's slow, the fixed costs and ongoing investments keep pushing forward, squeezing those profit margins.
That's a good analogy. But despite these evident challenges, there is a crucial strength for MSC, particularly valuable during economic downturns. And that's its consistent ability to adeptly manage working capital and generate robust cash flow. In fiscal 2024, management specifically drew attention to meaningful progress on working capital, which was a key contributor to the company's strong cash flow performance that year.
So they're managing their inventory and receivables well.
Apparently so. Even amidst a decline in net income, cash flow has remained remarkably resilient. MSC generated an impressive $410 million in cash flow from operations in fiscal 2024. That represented an exceptional conversion rate of 160% of net income. Very efficient conversion.
Wow, 160%. How does that work?
Well, it means cash flow was significantly higher than reported net income, often due to things like depreciation, which is a non-cash expense, and efficient working capital management, collecting receivables quickly, managing inventory tightly. For the first 9 months of fiscal 2025, net cash provided by operating activities totaled $253.5 million. Now, while this figure was down from $303.4 million in the comparable prior year period, mostly due to lower net income, it still signifies solid cash generation, especially considering the difficult operating environment.
Okay, so cash flow is holding up better than profits.
Exactly. And the broader implication here is that this capacity to convert earnings and even non-cash items like depreciation into liquid cash is a critical element of the company's financial stability. It provides a vital buffer during challenging economic periods, offering flexibility even when profit margins are significantly constrained. It's a key strength to watch.
That sustained cash flow generation is indeed a vital sign of resilience during a turbulent period. To truly put these trends into context, let's briefly review MSC's 5-year financial summary. Looking at the key metrics we have, net sales, gross margin percentage, adjusted operating income, adjusted operating margin percentage, adjusted diluted EPS, and operating cash flow, from fiscal year 2020 to 2024, it paints a pretty clear picture. We see net sales peaking there in 2023 at over $4 billion, followed by that noticeable decline in 2024 we discussed. Gross margin percentage has remained relatively consistent, hovering around that low 40s mark. But both adjusted operating income and the operating margin percentage show a clear downturn in 2024 after a strong 2023.
The squeeze is visible there.
Very visible. Adjusted diluted EPS follows a similar pattern. But operating cash flow, as you just highlighted, demonstrates its resilience, maintaining pretty solid levels despite the declines elsewhere. This historical data visually confirms the cyclical nature of the business's performance. It provides essential context for understanding the recent downturn and the current pressures. The peaks and valleys are unmistakably clear, underscoring the company's deep sensitivity to the broader industrial economy. It's been a dynamic financial journey, to say the least.
It really has. And a particularly insightful aspect of MSC's recent trajectory is how these challenges have sort of converged. The period from, say, 2022 to 2024 has been exceptionally demanding for MSC Industrial. It's been defined by this confluence of external macroeconomic pressures and significant internal execution missteps, a tough combination. The primary external headwind, as we've thoroughly discussed, has been that persistent, deepening slowdown in the U.S. industrial economy, a trend that really took firm hold in 2023 and continued throughout 2024. Management has consistently pointed to this deteriorating environment as a root cause of its declining sales volumes, citing those contracting readings from the Industrial Production Index and, more specifically, the Metalworking Business Index, the MBI, which, again, remained in negative territory for over a year and a half.
So the external environment was undeniably tough.
Undeniably. But compounding this already difficult macroeconomic backdrop were what MSC themselves termed significant self-inflicted wounds related to the execution of key strategic initiatives. The most damaging of these, it seems, was the full rollout of that web price realignment during the third quarter of fiscal 2024. While the intent, apparently, was to enhance MSC's online price competitiveness, aiming for a roughly neutral gross margin outcome, the unforeseen consequence was that unexpected dip in gross margin we talked about.
Right, the plan didn't quite work as expected.
Not at all. Management subsequently admitted that the pilot program for this initiative was, quote, not robust enough to surface these complexities. It revealed that the company's highly intricate pricing and discounting algorithms interacted in unpredictable ways when they tried to scale it across the entire product catalog.
Ouch. That sounds like a major IT and process failure.
It was far from a minor operational hiccup, yes. It was a very public failure of a major strategic project that directly impacted profitability and, frankly, undeniably called into question the company's technological capabilities and project management discipline. The stumble strongly suggests a potential gap in technology and data analytics compared to maybe more digitally native or larger-scale competitors. And it creates a significant execution risk overhang for any future digital initiatives they undertake.
That's a serious shadow to operate under.
It is. So the combined effect of these external factors, the macro slowdown, and these internal factors, the execution stumbles, created this powerful pincer movement on the company's profitability. You had declining sales, compounded by gross margin erosion, all while they were still making continued strategic investments. This led directly to that sharp decline in adjusted operating margins, powerfully demonstrating the severe financial impact when cyclical headwinds collide with poor internal execution.
That pincer movement truly encapsulates the intense pressure MSC is experiencing. Feels like they were being squeezed from both sides. However, despite these recent hurdles, MSC's management is not just sitting still. They've outlined a multi-pronged strategic framework, branded as the Mission Critical program, aimed at reigniting growth and bolstering profitability over the long term. Now, the initial phase of this program, spanning fiscal years 2021 to 2023, was actually quite successful, apparently. It delivered on cost savings and helped the company achieve above-market growth during that period.
They did have some good momentum there for a while.
Right. Now, management is embarking on what they refer to as the next chapter of this program, and it's structured around 5 key pillars. Let's break down their strategic roadmap. First, they are dedicated to maintaining momentum in high touch. This involves continuing to invest in and leverage their core strengths, that metalworking expertise, the vending solutions, meticulous large account management. Play to your strengths.
Makes sense. Double down on what works.
Second, and arguably the most critical and currently challenged pillar, is re-energizing core customers. The paramount focus here is on delivering a vastly improved e-commerce experience to both win back and grow market share within their traditional customer base. This is where that digital fix comes in.
That's the big one. Absolutely crucial.
Third, they aim at expanding the solutions portfolio, broadening their array of value-added services beyond just selling products. Fourth, they are streamlining the operating model, driving further operational efficiencies like that Columbus CFC closure we mentioned. And fifth, they're focused on strategic working capital management, continuing their emphasis on robust cash flow generation through efficient inventory and receivables management. The ultimate objective of this ambitious mission-critical program remains, and this is bold, to consistently outgrow the broader industrial distribution market by at least 400 basis points over the course of an economic cycle.
400 basis points. That's 4% above the market growth. That is a very aggressive target, especially given the recent performance.
Very telling, isn't it? Sets a high bar.
It does, and an integral part of bolstering that strategy involves a disciplined approach to acquisitions. MSC employs what they call a disciplined acquisition strategy that primarily focuses on smaller, bolt-on deals. These are complementary purchases that integrate easily, designed to enhance their strategic capabilities and reinforce that high-touch model. This M&A activity has generally concentrated in two main areas. First, strengthening technical expertise and services. The company has acquired numerous regional metalworking distributors and service providers. Notable deals include KAR Industrial up in Canada, Buckeye Industrial Supply, William F. Hurst, which brought specialized aerospace expertise, and Ingman Taylor. Crucially, it has also acquired custom tool manufacturers like True Edge Grinding. This significantly deepens its technical capabilities and allows it to offer more comprehensive, tailored manufacturing solutions, not just distributing, but creating.
Moving up the value chain a bit there.
Exactly. Second, they've strategically focused on product line expansion in adjacent categories. MSC has made acquisitions like Tower Fasteners and all integrated solutions to bolster its OEM fastener and components business. So, putting this into a broader context, this M&A strategy appears meticulously designed to fortify the company's competitive moat in those technically demanding, value-added areas, while it simultaneously works to address and resolve the issues with its broader digital and e-commerce platform. It's a clear strategy. Build strength where you already excel, even as you tackle areas of identified weakness.
That perfectly illustrates how they're shoring up their strengths while actively addressing vulnerabilities. Makes strategic sense. And despite those significant setbacks in 2024, investment in technology, they say, remains a top strategic priority for MSC. Management has openly acknowledged the shortcomings of its current e-commerce platform. They've committed to implementing substantial improvements to areas like search accuracy, relevance, the overall user experience, the things customers notice immediately online.
They have to. The competition isn't waiting.
Exactly. This digital turnaround is not merely important, it is fundamentally critical to that re-energized core customers pillar of the mission-critical plan. And it is arguably the single most important variable for the company's future growth trajectory. So what does this all mean for you, the listener, as you consider MSC's ability to compete effectively in this rapidly evolving industrial landscape? It means this digital battle is an absolute must-win for MSC. Their long-term future really hinges decisively on getting this right. No question about it. Now let's turn our attention to the financial mechanics, how they manage their money through capital allocation and also corporate governance. MSC's financial strategy is fundamentally centered on maintaining a, quote, solid balance sheet, while meticulously balancing investments for growth with direct returns of capital back to shareholders. A classic balancing act. Returning capital through dividends is definitely a core component of its financial policy. The company boasts a long history of consistently paying a regular quarterly dividend. And notably, they've increased their annual dividend payment for 3 consecutive years, even through some of these challenges. As of mid-2025, the annual dividend stands at $3.40 per share. This translates to a dividend yield of approximately 3.7%, which is a notably significant yield within the broader industrial sector. It stands out.
That is quite high compared to peers.
It is. However, there's always a however it seems, and this commitment to dividends results in a relatively high payout ratio. It was approximately 72% of trailing 12-month earnings as of early 2025. Now, while that's currently sustainable with their existing cash flows, thanks to that resilience we discussed, this elevated payout ratio leaves less room for error. It could become a point of concern for investors if the current earnings downturn is prolonged or deepens. It could potentially limit financial flexibility or raise questions about the dividend's long-term security. It's something to watch.
So the dividend is nice, but it takes up a big chunk of the earnings.
A very big chunk. In addition to dividends, MSC utilizes share repurchases as another mechanism for returning capital. They have an active authorization and periodically buy back their Class A common stock. However, the pace of these buybacks has slowed considerably in direct response to the recent operational and financial challenges. In the first 9 months of fiscal 2025, MSC repurchased only $39.1 million of its stock. That's a sharp reduction from the $167.2 million they repurchased during the same period in fiscal 2024.
Okay, so they're pulling back on buybacks to conserve cash.
Seems that way. It indicates a more conservative capital posture aimed at preserving cash and maintaining crucial balance sheet flexibility during this period of heightened uncertainty. Prudent, perhaps. Finally, on the balance sheet itself, MSC maintains a moderate approach to leverage. As of May 31st, 2025, the company's total debt stood at approximately $521 million. Relative to its earnings power, this debt level is quite manageable, and the company's strong history of cash flow generation provides a buffer to service its debt obligations. However, credit metrics will be an important area for close monitoring. Should the industrial downturn worsen and EBITDA continue to decline, leverage ratios would increase. And that could potentially constrain the company's ability to invest in vital growth initiatives or continue its capital return programs at their current levels.
Right, that flexibility is key.
Ah.
So prudent balance sheet management seems critical during these challenging times. Let's also examine the quality of MSC's management and, importantly, a truly significant shift in its corporate governance. This is a big deal. MSC's leadership is characterized by deep, long-term insider experience. The company is led by President and CEO Eric Gershwin, who is actually the grandson of the founder, Sidney Jacobson, and Mitchell Jacobson, the founder's son, serves as chairman. So long-standing family leadership, which generally suggests a deep commitment to long-term success. The broader executive team also possesses substantial industry experience.
Lots of history there.
Lots of history. However, the management team's execution track record, as we've discussed, is currently mixed. The initial phase of the mission-critical strategy from 2021 to 2023 was commendably well executed. They consistently delivered on stated financial and operational goals. But, and this is a substantial caveat, the significant operational failures in 2024 related to the e-commerce and pricing initiatives have undeniably tarnished this record. No getting around that. It raised legitimate questions about the team's capabilities in managing complex, large-scale technology projects. The ability to successfully navigate the current digital transformation is now the primary, definitive litmus test for evaluating management's ongoing effectiveness. All eyes are on that.
Fair assessment. The pressure's on.
Definitely. Now, a particularly significant and positive shift occurred in MSC's corporate governance in 2023. This is quite important for anyone interested in transparent corporate structures, and frankly, it was overdue for some investors. The company announced and subsequently approved an agreement to entirely eliminate its dual-class share structure.
That was a big deal.
Huge. Under the prior structure, the Jacobson-Gershwin family held Class B shares that carried 10 votes per share. This gave them effective voting control despite owning a smaller economic stake in the company, a common structure but often criticized. The reclassification, where all Class B shares were exchanged for single-vote Class A shares, represents a major enhancement to corporate governance, a really positive step. This change aligns the voting power of all shareholders with their economic interests, which is a structure highly favored by institutional investors. One share, one vote.
Much cleaner, more aligned.
Exactly. This move effectively removes a long-standing governance discount that may have been applied to the stock by some investors, and it demonstrates a clear commitment to modern governance standards. This is a big positive for both transparency and investor confidence, wouldn't you say?
Oh, absolutely. It removes a major point of contention for many governance-focused investors. A very smart move in the long run. And that governance shift is indeed a critical positive, but it brings us right back to the ultimate question. What is MSC Industrial Direct truly worth? Let's talk valuation. As of early 2025, MSM trades at a trailing 12-month price-to-earnings, or PE, ratio of approximately 25.6x. Remember, that means investors are paying $25.60 for every dollar of the company's past year's earnings. Its price-to-sales, or PS ratio comparing market cap to total revenues, stands at about 1.3x. Now, while the PE ratio is currently below its recent peaks, it actually remains above its longer-term historical average of around 21.0x. This suggests that the market is implicitly anticipating some form of recovery baked into the price.
Interesting. So not trading like it's doomed.
Not entirely, no. The PS ratio, which averages around 1.5x over 5 years, is more in line with its historical norms. Benchmarking against its peers provides that crucial context again. MSC's PE multiple of about 25x is substantially lower than Fastenal's premium valuation of around 48x. Big gap there. But it's quite closely aligned with W.W. Grainger's at approximately 26x, and Applied Industrial Technologies also at about 26x. This disparity suggests the market values Fastenal as that superior, more consistent growth company, while grouping MSC with the more traditional cyclical industrial distributors like GWW and AIT.
So it's seen as the more cyclical, less of a growth engine than Fastenal.
That seems to be the market's view reflected in the multiples. On a revenue basis, the PS ratio, the valuation disparity, is even more pronounced. MSC's PS ratio of about 1.3x trades at a significant discount to both Grainger at roughly 2.8x and especially Fastenal at about 7.4x. This large gap distinctly reflects MSC's lower profit margins and its recent negative revenue growth compared to those larger peers. Looking again at enterprise value to EBITDA, TTM, MSC's 13.5x also trades at a discount to most peers. However, as we noted, MSC's dividend yield of about 3.7% is notably higher than its competitors. So the takeaway here is that the current valuation appears to strike this delicate balance of conflicting factors. The multiples seem to have largely priced in the cyclical downturn in the manufacturing sector. However, it is less clear whether they fully account for the heightened execution risk demonstrated by those recent technology-related missteps. That's the key uncertainty.
That's a very clear summary of the conflicting signals at play. The current valuation truly reflects a delicate balance of market perceptions. It could go either way, maybe. So let's consider the bull case for MSC. A bull, someone optimistic, would reasonably argue that if management can successfully execute its digital turnaround, that essential must-win battle we keep mentioning, and the broader industrial cycle decisively recovers, then the company could potentially see both robust earnings growth and a subsequent expansion of its valuation multiples. There's considerable upside potential if they get these crucial elements right. The leverage could work in their favor.
Right. The cyclical recovery plus fixing the internal issues could be powerful.
Conversely, the bear case. Someone pessimistic would contend that continued operational stumbles, particularly in their digital transformation efforts, coupled with maybe a prolonged or deeper industrial downturn, that could lead to a further derating of the stock. This scenario would cause it to trade at an even greater valuation discount to its peers, accurately reflecting a higher, sustained risk profile. The market might lose patience. So for you, our listener, which side of this tension resonates more strongly? Given all the comprehensive information we've meticulously uncovered in this deep dive, it's a genuinely complex and multifaceted question that warrants careful consideration. There's no easy answer here.
No easy answer at all. And to truly make an informed decision on MSC Industrial Direct, it's absolutely critical to conduct a thorough risk assessment. We need to carefully consider several key business, competitive, and financial risks. First, on the business and macroeconomic front, cyclical exposure. This represents the most significant and inherent risk to the business. We've hammered this point, but it's crucial. MSC's heavy concentration in the metalworking and general manufacturing sectors renders its revenue and profitability highly susceptible to the vagaries of the business cycle. An industrial recession or just a prolonged period of weak capital investment would inevitably have a direct and materially negative impact on its financial results. Period.
Can't escape the cycle.
Can't escape it. Then we have supplier dependence. Like all distributors, MSC relies extensively on its relationships with a multitude of suppliers for access to that diverse product range. The loss of a key supplier or even just a significant disruption in its supply chain, think pandemics, geopolitical issues, could profoundly affect product availability, costs, and customer relationships. They don't make the stuff, they distribute it.
Right, they're the intermediary.
Exactly. Furthermore, effectively managing an inventory of over 2 million SKUs across a complex national distribution network is a formidable operational challenge in itself. A failure to accurately forecast demand can lead to either excess or obsolete inventory resulting in costly write-downs, or, conversely, insufficient inventory leading to lost sales and unhappy customers. It's a constant balancing act.
Tricky business, managing that much stock.
Very tricky. Moving to competitive and operational risks, intense competition is just a constant factor. MSC faces relentless pressure from larger, better capitalized rivals like Grainger and Fastenal, who possess greater scale and resources, and also from thousands of smaller, nimble competitors who can compete aggressively on price at a local level. Pressure from above and below.
Squeezed again.
Right. Execution and technology risk is also paramount now. As starkly highlighted by the recent failures with its web pricing and e-commerce initiatives, there is a significant risk that management will simply be unable to successfully execute its critical digital transformation. Further missteps in this area could permanently impair the company's competitive positioning, particularly against those more digitally savvy competitors. The window might close. This naturally leads to market share risk. A failure to keep pace with the evolving service models and digital capabilities of its competitors could lead to a tangible loss of market share, especially among those large national accounts that are primary targets for all the major players.
Those big contracts are where the real money is?
Absolutely. Finally, let's consider the financial risks. While the company's debt levels are currently manageable, as we said, a severe and prolonged earnings downturn could cause leverage ratios to rise to uncomfortable levels. This could potentially limit financial flexibility, make borrowing more expensive, and increase the cost of capital overall. And dividend sustainability is a key point for investors to monitor closely. The company's dividend payout ratio is relatively high compared to its current earnings. If earnings remain depressed or decline further, management could face a very difficult choice. Either reduce the dividend, an action that would likely be viewed very negatively by income-focused investors, or continue to pay it, potentially at the expense of crucial balance sheet strength and vital growth investments.
A tough choice indeed.
Okay.
Pays the shareholders or reinvest in the business.
Exactly. And these aren't merely hypothetical risks, right? Some of them, like the cyclical downturn and the execution risk, are already actively impacting the company's financial and operational performance right now. This makes them absolutely essential considerations for any truly informed decision about MSC.
Okay, so after this really deep dive, what does all of this ultimately mean? Where do we land? We've explored MSC Industrial Direct as this deeply integrated, value-added distributor with a strong, specialized niche in metalworking. That's their core identity. However, it's clearly battling significant cyclical headwinds in the manufacturing sector and, crucially, needs to definitively prove its execution capabilities in a critical digital transformation. That's the big challenge. We've uncovered the intrinsic link between the broader industrial economy and MSC's performance. You can't separate them. We've seen the double-edged sword of its metalworking specialization, both a strength and a vulnerability. We noted the surprising resilience of its cash flow, even in a downturn, which is a definite positive. And we highlighted that significant positive stride in corporate governance with the elimination of the dual-class share structure. The company had a truly fascinating and pivotal moment in its history, wouldn't you agree?
Absolutely pivotal. And thinking about this within the broader context of industrial evolution, MSC's current journey, I think, raises a fundamental question for really any business today, especially traditional ones. In an era where even the most traditional, high-touch industrial staples are being rapidly digitized, how long can a company truly rely on its specialized knowledge and personal relationships before a superior, seamless digital experience becomes the ultimate, indispensable competitive moat? And perhaps more importantly, how quickly can they genuinely build that digital moat before it's potentially too late? It's a race against time and technology. So what aspects of MSC's situation stand out most to you, our listener? And which elements would you be watching most closely if you were following this company's story unfolding? Something to ponder.
That's a powerful question that definitely resonates far beyond just MSC Industrial Direct. A great thought to end on. Thank you for joining us for this deep dive into a company that truly plays a vital, albeit often unseen, role in keeping the industrial world moving. Keep digging, keep questioning, and as always, stay incredibly well informed.